All right, if you're tackling CFA Level 2, you know convertible bonds are a huge topic in fixed income. And for good reason. They're this fascinating mix of debt and equity, and really understanding how they behave, well, that's absolutely key for acing that section. So let's break it down and get you ready.
So here's our game plan for today. We're going to start with the basics, what makes this thing a bond-stock hybrid. Then we'll get into how to actually deconstruct its value. After that, we'll talk about its price floor, a concept you have to know. Then the fun part, how it acts like a financial chameleon. And finally, we'll lock in those core takeaways you need for the exam.
Okay, first things first, let's get right to the heart of it. What exactly is a convertible bond? You got to think of it as a security with a split personality. And to really master it, we need to understand both sides of that coin. I mean, this is the big question, right? How can one single investment act like a super safe conservative bond when things are looking gloomy, but then turn around and ride the wave like a high-growth stock when the market takes off? The secret is all in its unique hybrid design.
So here it is. A convertible bond is basically two things mashed into one. First, you've got a normal, plain vanilla bond that pays your coupons and gives you your principal back at the end. But, and this is the magic part, it also has a call option on the company's stock built right in. This gives you, the bondholder, the right, but not the obligation, remember that, to swap your bond for a specific number of shares. That little embedded option is the engine that drives everything else we're going to talk about.
Let's make this real with an example. You have to know these three terms cold. First up is the conversion price. That's the preset price per share you'll pay if you decide to convert. Next is the conversion ratio, which is just how many shares you get for your bond. You calculate that by taking the bond's face value and dividing it by the conversion price. And finally, you have the conversion value. That's the real-time market value of the shares you'd get if you converted right now. These three are the building blocks, so make sure they're second nature.
Okay, so we know the parts, we know the terms, but what's this thing actually worth? To figure that out, we need to break the convertible bond down into the sum of its parts. It's all about deconstruction. And you know what? The valuation is actually pretty intuitive, which is nice for a change. The total value of a convertible is simply what a regular, option-free bond would be worth, we call that a straight bond, plus whatever that embedded call option is worth. All we have to do is value those two pieces and add them together.
I mean, the curriculum itself puts it perfectly. Don't try to overcomplicate it. At its very core, a convertible is just a straight bond plus a call option. If you can remember that simple idea, you've got the foundation for everything else. So how do we get that straight value? We treat it just like any other bond. First, you map out all the future cash flows, every coupon payment, and that final principal repayment. Then you just discount all of those back to today using the right discount rate, which has to account for the benchmark yield and the company's credit risk. What you're left with is the bond's baseline value, as if that conversion option didn't even exist.
Now, understanding those two separate pieces of value, the bond and the option, leads us to a really crucial concept for the exam, the law of one price. This creates a valuation floor for the convertible. But what's cool is that because of its hybrid nature, it actually has two potential floors.
And here they are. Think of it like this. You've got two different safety nets. The straight value is its safety net as a debt instrument. It's driven by interest rates and the company's credit quality. The conversion value is its safety net as an equity instrument, and that's driven by the stock price. Here's the key. A convertible bond's price should never, ever fall below whichever of these two values is higher.
So why is that such a big deal? It all comes down to arbitrage. Because if the price did somehow dip below that floor, it would create a golden risk-free profit opportunity. Traders would pounce on it, buy the cheap bond, and their buying pressure would instantly push the price right back up to where it's supposed to be.
Let's go back to our WMU bond to make this real. Imagine its straight value is about 98,000 pounds, but its conversion value is almost 104,000. Now, what if, for just a split second, that bond started trading at its straight value? Well, an arbitrager would swoop in, buy the bond, immediately convert it into stock, sell those shares on the market, and walk away with a completely risk-free profit of over 5,000 pounds. The market just doesn't let free money like that sit around for long.
Okay, so we know it has both bond and stock DNA, but which personality takes over? When does it act like a bond, and when does it act like a stock? The answer totally depends on the stock price, and this is why people call it a financial chameleon. It changes its colors based on its environment.
So when the company's stock price is way down, far below the conversion price, that embedded call option is deep out of the money. It's basically worthless at that point. In this state, the convertible's price is driven almost entirely by its bond features, things like yield and credit quality. This is what we call a busted convertible,
and it pretty much trades just like a regular old bond.
Now, as the stock price starts climbing up and gets close to the conversion price, things get really interesting. Suddenly, that call option starts to have some real, tangible value. In this middle ground, this hybrid zone, the bond's price becomes sensitive to both changes in interest rates and movements in the stock price. This is where you get that unique, balanced profile of bond-like safety with a nice dose of stock-like upside.
And finally, the best-case scenario, the stock price takes off and soars way above the conversion price. Now that option is deep in the money. At this point, the bond's value is almost completely tied to its conversion value. It's going to trade in lockstep with the stock, almost tick for tick. It is fully transformed into an equity equivalent.
Okay, let's bring it all home. What do you absolutely positively need to have locked in for exam day? The most important skill here is being able to look at a convertible bond, quickly figure out which state it's in, and know exactly what's driving its price at that moment.
Think of this as your exam cheat sheet. You need to remember these 3 things. Number 1, its total value is the straight bond plus the call option. Number 2, its minimum value is the higher of its straight value or its conversion value. And number 3, its risk profile, that chameleon's color, is all about where the stock price is relative to the conversion price. If you can nail these 3 points, you're going to be in fantastic shape for any question they throw at you on this topic.
So let's end with a quick test to put it all together. You've got a convertible bond where the stock is trading at $28, but the conversion price is $43. Is this bond going to be more sensitive to a change in interest rates or a change in the stock's volatility? Well, since the stock price is way below the conversion price, we know it's a busted convertible. That means its value is going to be driven by bond factors, interest rates, and credit spreads, not what the stock is doing. This is exactly the kind of thinking you'll need to do on exam day.